Yeah.
All right. People are funneling in. We'll get going here in a second. Come on in. Let us know where you're calling in from in chat. We usually get a decent amount of coverage all over the world. I won't be surprised if we see people in Europe on here. So feel free. See Boston. All right. Close to Europe-ish.
It's all relative.
Denver. Wow, we got two Jennifers with almost the same name. First and last. Should look at that. All right, I'm gonna get my screen ready to share here. Play
Expanded.
Speed City. Awesome.
There we go. We got a London.
Welcome. There we go. London. I'm in Chicago. Kansas City. There we go. Another London. We got a lot of London. We have a great London community. It's a good reason to go. I love going to London. So awesome. Well, we're gonna get started here in one more minute. We will send out a recap when this wraps up. And we maybe in a week or so, as well as recording. I think we're just going to go through a couple legal things to get the recording approved. But yeah, we will send out this recording and the recap once we wrap up here today. But yeah, we'll go ahead and get started. Feel free to send any questions to myself or to Lisa. Our team is also monitoring the Q&A channel. So if it makes sense, we'll hit pause and answer real time, or we'll definitely save some Q&A for the end. We'll try to keep this about 45 minutes or so and let everyone get on their way. But just by introduction here today, kind of set the stage. We're talking about all things, I think, emerging managers and operational excellence. I think it's a kind of a lens in which both Visible, Lisa, and Screendoor can really give some great opinions and insights and hopefully answer some of the questions you guys have. But I'll do some introductions and we'll be on our way. So first, my name's Mike. I am the founder of Visible. Visible serves both venture funds and founders all over the world. We'll talk a little bit about Visible here in a second. But I'm really excited to have Lisa join us today. She's the managing director of Screendoor, one of the preeminent fund of funds backing early stage venture managers. And she originally joined from the LP side, where she spent a lot of her career in private investment portfolios and funding new ventures, really across all different kinds of stages, sectors, and geographies. So, Lisa, thanks for spending some of your time joining us here today.
Thank you guys for having me. Super
We'll
pumped.
get.
This is my favorite topic.
Oh, excellent. I'm excited to dive in, and I'll give a kind of a quick talk check about Visible, and then we'll let you give a little spiel. Actually, sorry about yourself, Lisa. Anything I missed there?
No, I think I'll just hit it home for Screendoor. It's, you said it well, VC fund of funds. We focus on early stage managers. Important thing to know about us. So we write anchor style checks and then we help our GPs build their firms. So we're a really active LP to our GPs. And then to our LPs, we help bring them this access to their portfolio. So I also have two really incredible partners who have decades of experience in the LP world. And then, as you know from actually your podcast and some of the genesis of this, one of the unique elements of our model is our group that we call our GP advisors, who were the founders of the firm. So folks like Hunter and Satya of Homebrew and many others who are actually embedded in the DNA of our firm. And so they're really active in our sourcing, our selection, our support, and also helping our portfolio navigate this operational topic.
I'm not sure if it's biased or not, but I feel like I'm seeing Screendoor like more and more online now. I feel like when I'm on X or LinkedIn and people are talking about, some of the changes in the capital markets, I feel like I see Screendoor all of the time come up for as like a great LP for emerging managers. So you guys are whoever's doing marketing is doing something right for you all.
Love it.
What real quick on kind of like you mentioned anchor LP check. Are we talking like fund one, fund two? Like where do you maybe start and end just to help kind of our audience understand where you typically invest?
Yep. So we've made it, what, 6 minutes before I had to give out the classic LP, it depends answer. So we are not rigid in terms of like what the fund number is on a legal document. I think that's actually a really important distinction in emerging managers because sometimes you might have a fund three that's the first institutional fund, but there have been, two portfolios of SPVs and things like that before. So we generally fund one, two, and three. But we are not dogmatic about what that kind of like legal letter is. I'd say a better range and ballpark for us is typically a floor of $10 million dollars in fund size. So we think of it as like that first institutional fund.
Okay. Great. Thank you for that. And a little bit about Visible. I see a lot of names I recognize and some new ones, but just a little bit about us. We're a connected AI portfolio monitoring and reporting solution. We work with over 950 different venture funds all over the world. We also started as a product for founders. So we serve over 6,000 founders all over the globe as well, and really pride ourselves on waking up every day thinking about how we can better equip both founders and investors to build. And just really grateful for the time for all of you that have joined and some of the things that we're going to talk through today. Again, if you have any Q&A, please feel free to submit them in chat. We'll get to them as best we can, but we'll go ahead and kick some things off here. So one, we're going to cover kind of operational inflection points. I think a lot of the customers we work with, and I'm sure a lot of the ones that Lisa works with, kind of have these inflection points throughout their growth and especially early on. We'll talk about scaling portfolio support. Now, a lot of the folks I see here that are current Visible customers are in the portfolio support world. Going from partnership to platform, LP communication as a signal of quality. And then lastly, I think a topic a lot of you are keen to hear about too is kind of raising funds to and beyond. So maybe just to kick things off in talking through operational inflection points. Like first question for you, Lisa, is like when firms already have 20, 40, or 75 portfolio companies, like what breaks first? Is it the data integrity? Is it their follow-on discipline and decision making? Is it their internal dynamics within their firm? Is it LP reporting? Is it all of those things? Like, yeah, just give us your thoughts.
Yeah, for sure. So I think it's really hard to be prescriptive around the exact stage of a firm or number of portfolio companies where things can automatically break because it's so dependent on the combination of both the portfolio model and then the team that's running it. And look, like, I'll be the first to tell you just to set the stage, like, none of what I say today will matter if you don't have good returns. Like, that's it. That's the job, full stop. Like, we can all kind of end and go home here because you can't operate or out operate, I should say, your way to good returns. Strong operations won't hide bad returns. And I think that that's something that so many people get wrong. They actually start to spend consistent time on the operations without bringing that back to their investment. And to me, I think, reporting, portfolio tracking, support, fundraising, compliance, like all of these things are important requirements to do the job, but they're not the job if you're the GP. And so, what the operations and the tech and the tooling and all the talented professionals who specialize in this can do is they can actually help you accomplish the non-investment parts of the job so that you, as the GP, can be spending a majority of your time and attention on generating returns and then maintaining the relationships that really fuel your sourcing and your returns. And so, to specifically answer your question, I think that's where I believe that the follow-on discipline is the first thing that you start to see cracks in the system, where
Mm,
either there's a misalignment of time, there's actually a lack of infrastructure. And I think that that bears the brunt of it because it's where your behavioral bias has the potential to be the strongest. And I'm not necessarily talking about the obvious decisions, right? Like the very clear rocket ship, like back up the truck, the very clear, like, hey, this is a definitive no, and we need to kind of close this chapter. But I think a lot of this, the challenge really lives in the middle ground where you've sunk in time, you've sunk in obviously capital, so much more into a company. And so you decide to use more follow-on capital. And there's obviously stories where this has been an amazing bet and that has all worked out. But I actually think more often than not, I don't know that that holds. And so I think when you look at this actually applies for LPs too, and I know there's a couple LPs that I recognize here too. But in the traditional like CFA, CFP world, there's this concept of the endowment bias, and no, not like endowments of universities, but it's this cognitive bias where people assign a higher value to an object or an asset just simply because they own it and hold it. And so you see that in re-ups for LPs, you see that in follow-on decision making, and the way that this operational, excellence, as we call it, kind of comes into play is that you need to have these systems in place that are feeding you the data that you need, that are getting you information as fast as possible, because otherwise you're relying on stale information and you're going based on your gut. and you're going based on this endowment bias, whether you know it or not, that I think is actually fueling where you're putting capital at play. And so I think that's where it breaks your returns, which again, as I said and led with, is kind of the only thing that matters. But I think it's the follow-on decisioning around where and where not to deploy capital. And that's where then it bleeds into your communication, it bleeds into data. And so there's a lot to unpack there, but I think that's where we start to see it first and foremost.
That's really interesting. How do you, as a LP and allocating capital, like how are you testing for this and diligence and the funds you're working with? Like, what are you looking at in particular to see like are they a good allocator of follow-on capital? Do they represent any of these biases? And maybe it's hard to know for fund one, but like, yeah, what how are you evaluating GPs as you're thinking through this?
Yeah, there's a couple avenues. I actually think the first is we're seeing less and less of a focus on having follow-on reserves in a portfolio construction model. Now, that's, I would say, is like very specific to a lot of the managers that we happen to work with, right? Smaller funds, they are pre-seed and seed. And so to tip my hat to my partner, Jamie, there's a lot of data out there that supports having those additional initial checks in a portfolio versus what difference do you know between making that pre-seed round and then in these days, like 6 months later, a seed or an A coming through? And so there's not a lot of net new information and it's still quite early stage. And so I think some of the ways that we're looking at testing it is actually we think about the follow-on or the reserves in a portfolio construction model as more being your flexibility and like your edge,
Mm,
not necessarily this has to methodically go into 5 companies, and that's on day zero what my plan is. And if I don't follow that, then I've broken my model. So we think of it as that's your way that as you move throughout your investment period, you can choose how you want to deploy that capital. And it doesn't necessarily need to go into a subsequent round of an existing company. It can go into, hey, I'm going to split this up into 3 additional net new checks, or hey, look, I know I have a winner in my portfolio and I'm going to continue to concentrate my capital there. So we look at it more as optionality. And then how we're testing for that in a lot of our diligence is just understanding that mental model. And so there's kind of one of two paths, somebody who has very clearly thought about this and thought about the different avenues that they can take, and someone who is like, I don't know, I'm just going to figure it out as I go. And we hear a lot of the second, and we also hear a lot of the first, though.
yeah. I'm curious, like, I think the reserves debate is a debate, an ongoing debate.
Yeah.
But like, I guess in 2026, like, does Screendoor have an opinion on like the reserve model, maybe in terms of percentage of the portfolio, or in terms of like, yeah, we're okay funding someone that is going to say we're going to do no follow-on investments. I'm curious to hear like where the market is, I guess, in your mind today in terms of reserve strategy.
Yeah, for Screendoor specifically, we back all sorts of models. So we have concentrated models and very concentrated models in our portfolio. And then we also have quite diversified, like upwards of 60, 70 plus portfolio companies. So we actually think all of those can work. And if you've heard me speak before, you kind of know one of these tenets I have is that like I don't think there's any one right way to do venture, but I do think that there's one right way to do venture per person, where like there's one,
Mm,
it has to how do I say this? It comes back to who the GP is and what their skill set is. You can't drop somebody, similarly that's meant to be a solo GP into a partnership model. You can't drop a partnership model on somebody that really should be a solo GP. I think the same applies for portfolio construction, where if your style and your strategy is to be deeply embedded with these companies, it's highly unlikely that a highly diversified approach will work for you. And obviously the reverse is true. So it's a little bit of, again, that LP, like it depends answer. But I think the most important thing is that the portfolio construction matches the GP executing it in the space where they plan to invest.
yeah. Okay, so you mentioned follow-on discipline. I'm curious if there's another one of these jump off the page to you as like uh, one that could affect returns at the end of the day, where you see things break after the follow-on discipline.
Yeah, I think a lot of it is actually around the internal communications, particularly as funds go from a fund one through, scaling up in that fund two and fund three. And the reason that I think that tends to happen is because you typically are adding additional human capital to your team. And so anytime you add a net new person, no matter what size team you start with, you have additional complexity in your communications and making sure that data, both in your systems and your people, is talking across one another. So, for example, if you have two partners, if you are a solo GP and now you have two partners for the next fund, you need to make sure that you're blocking and tackling on investments and that each partner has the same information such that it can inform your decision making, both around initial investments or the follow-on piece that we just went through. And so I think that is where we tend to see things start to disintegrate again, which then can bleed through. Everything else feels a little bit more systematic, albeit not
Hmm.
perfectly. But I think it's a lot of the kind of the softer, nuanced things that tend to fall through the cracks.
Yeah. One last question before we move on. Returns, you said that's all that matters at the end of the day. But like at what point does like Scrappy stop, being a strength and it becomes like a risk?
So I think that there is a difference between being scrappy and what I'll say is sloppy, to be quite
Mm,
extreme about it, and being scrappy and nimble. And so, scrappy and nimble to me means that you are going to be successful and resourceful with constraints, and you know when to start delegating away so that you can protect. I'll give a nod to Kaufman Fellows here, the zone of genius of your time, right? Which should be focused on investing and working with founders and doing the things that only you can do. And so, if you're being scrappy and nimble as you're maintaining that focus of your time and you're delegating away all of the things that are not necessarily in your strike zone on that, or that other folks can have that as their zone of genius. Scrappy and sloppy just means that you're now creating blind spots for yourself where you're trying to do too much. You're doing things that don't necessarily have purpose. I think this is a dynamic we can probably explore throughout this conversation, but I think a lot of times people confuse having really sophisticated, high volume of data with being helpful and useful and productive. So
mm.
I think for me, there's a very fine line when somebody says they're scrappy. It's like, gosh, what does that actually mean? And it probably means one thing at fund one and maybe one thing at fund three. But I think a lot of it comes down to make sure that you're managing your volume in the right way. Because when, you have on the page here 20, 40, 75 portfolio companies, it's not just the count of companies, it's all of the back work that comes with that. It's the making sure you know what's going on there. It's all of the paperwork side of it, the audit, the communicating that to your LPs, working through, the decisioning around any net new portfolio companies coming into the fold. So there's a lot of volume that comes with just adding that additional line item too.
Yeah. Um, I'm sure I'm gonna put you on the spot because this is not on the question sheet here, but I think we have a lot of people here that are LPs. I think we saw. Definitely see some GPs. I see a lot of like operators within venture funds too that might not be on the investment team.
Mm.
For the folks that are like on the operational side that might not be in like any like advice or guidance you would give them as to like how you would give them like a charge to go to their GP or the partnership on some of the things you just said about sloppy versus scrappy and like any advice in terms of how those operators can work better with the partnership.
Yeah, that's a really good question. So I think one really underrated, it seems really trivial, but one underrated, I guess, process or motion that I think can really benefit a lot of businesses, no matter where you are kind of in the stack that you just outlined, is actually just revisiting why you're doing something. So
Mm,
as you set your processes around fund one and what your team may be there, then suddenly you've raised fund two, amazing. You start, having really great successes. The portfolio starts taking shape. You might have added some additional human capital, and you're still running the same processes. And you don't actually pause to say, why are we still doing this? Who is this benefiting? Is this actually giving me any value, or are we doing it just because? And I think you can get stuck in a lot of those motions because as your volume of portfolio management increases, as the need to deploy your new funds comes into play, that feels like a really small and trivial thing to stop and pause and do. Like it's so hard. I mean, I experience this constantly. It's so hard to carve out time in your days and weeks to spend time on what feels like it's not hitting your number one goal, which is around returns. But again, all of that sets a really efficient backbone. So I think if you're in an operational role, you are extraordinarily valuable to any team that you're a part of, and hopefully you feel that because I think you have the opportunity to really set the pace of why you're doing something or like what's not being done that, by the way, is super low-hanging fruit, but could add an insane amount of value. So, um, I think that that would be my advice.
Any good examples of the like low hanging like have you kind of observed across all the different funds you work with like any like process that's like low hanging fruit that people might not be thinking of? Putting
Hmm.
you on the spot there.
Yeah, that's a good one. I'll actually give maybe a hot take is I actually don't believe in adopting every single like net new AI tool out there the second it comes out. Um,
There we
I think
go.
sometimes it's it can become such a distraction. And so I think it's the obvious like low hanging fruit. Hey, let me try that thing because it's gonna like, solve this like one very custom part of my business or my workflow. And instead it just becomes a massive headache. You've shared potentially confidential information with an unvetted source. There's a whole host of ripple effects to that one decision. So I think that's why I actually always go back to I'm a former auditor, so I'm a little bit of a old school when it comes to this stuff. But like I think sitting down and mapping out the why is just so much more important.
Great. Give time for the why. Let's move on. That was great. Um, Kind of moving towards now scaling the portfolio supports. We kind of talked about where maybe things break. Um, I guess maybe kick off the questions here. Have you seen any examples where like lack of portfolio visibility impacts on decision making or LP confidence? I mean, we talked about this a little bit, I guess, in terms of like some of the follow-on decision making, but like, yeah, I'm curious of like maybe there for sure, but also like LP confidence.
Yeah, yeah. Since we did follow-ins, let's I guess dive a little bit into the LP side. So
Sure.
I think the short answer is absolutely. Like we see it all the time. We get calls from it all the time too. Whether it's, an existing LP for somebody or a prospective LP and they're trying to kind of weed through that web. I think it's readily apparent when a GP does not have visibility into their portfolio. A perfect example, and I have seen this, it feels like it happens time and time again. But I've seen funds where they have identical exposure to a company being marked at like widely different values on statements.
Mm,
And that's like a very discrete like financial statement item, right? Where there's like other, multiple players involved. But, I think there's an argument to be made that if you were up to date on what was going on with that portfolio, perhaps there's some other variables and factors there, which would maybe be a conversation for a different time. But I think that's one that's just reflective of like whether you actually have the pulse on what's going on in your portfolio. As a sidebar, and maybe kind of the other end of that coin is like, I actually think it's okay if the strategy that you pitch to LPs is not that you're going to be, so deep with every company. And for what it's worth, like, I think it's really important to protect founders' time at all costs. I think there's this motion of, I have to get all these updates from founders and like you create all this administrative burden on them when frankly, like you really want them focused on building the business and focused on outcomes. It's actually the same motion for LPs that I think they should expect of GPs. Like as an LP, like we want them working on finding the best founder talent and managing the portfolio, not necessarily fulfilling like aimless LP requests unless there's like really a clear reasoning or a clear stakeholder need. So I think actually my advice around that for a lot of GPs that we talk with and work with directly is making sure that LPs have visibility into their capital that's at work. And so the GP needs to make sure that they understand what's important to an LP when they're accepting their capital. So, what's their reporting motion? Like, are they managed by a
mm,
board of trustees or do they have to report to an IC very formally 4 times a year? Are they, a single decision maker group of three? And knowing like what those asks are. And then setting up and sticking to a communication cadence and reporting so that you can build that rapport and trust so that LPs know, like, hey, every quarter you're going to get, this set of information and here's what it's going to contain. Because I think that, also can build the trust and the expectation, then everything else can be taken care of in terms of like additional requests. So I think a lot of times, especially during fundraising too, you get LP requests and it's like, I think it's really important to understand the why behind why someone is doing something, not necessarily kind of gawking at the list of things. So,
would you ever advise um, a fund that you're working with to not um take like an LP check based on the why? Like what if it's the only option? Because I kind of come back to the founder side. Like, we talk to a lot of founders too in our work. And so it's like the founder's raising capital and they only have one term sheet. It's like sometimes that's the only option, right? And you have to take it even if you don't love it.
yep.
Does it work the same in the GP to LP world, or are there any other um yeah, I guess insights or kind of decision making I should think through there?
Yeah, I think it's so situational, and for what it's worth, just as like the human level, it is so hard to walk away from a check that feels like it's right in front of you. Like that's so hard and crazy to do. I think the framework I use when I go through, because again, I wear a GP hat and I wear an LP hat, so
Yeah.
I see both sides of it and have been in decisions like that. Um, I always think about two things. One, if it's weird now, it is not going to get any better. Like that is generally like as I've always found that to be true. The second piece of that is that would I want to call this person when I have bad news? And
Mm.
would I want to work through that with them? Because that's inevitable. Like in building a business, like it's going to happen. And so I think it's really critical. It comes back to a lot of the behavioral, bias that we kind of started with and the relationship element of all of this. So I think I can't tell someone in a very prescriptive way, like you should never take a check if this, or you should always take the check for that. It's so hard. But that's kind of two guiding frameworks that I use, both for folks that ask us for that advice and when I've been in that position as well.
This has nothing to do with this webinar, but like, what's the weirdest like DDQ request you've had to complete that you could share publicly? Is
Oh,
there anything that comes to mind? Because you said if it gets weird now, it's weird later. Is there like, what does weird look like?
yeah. I think someone will have to find me and buy me a coffee on the circuit to
All
hear the
right,
story.
all right, all right. Fair enough, fair enough. All right, great. Let's move on to kind of partnership to platform. Um, and as you kind of, yeah, as you kind of you mentioned human capital is adding human capital, adding some level of processes as you go and continue to build. Um, so yeah, as you start to maybe add investment partners, add to the team, have multiple funds now, what like internal complexity becomes most challenging? I guess we talked about communication being one, but like maybe expanding on that. Is there anything else that comes to mind or advice you would give to the GPs and LPs here?
Yeah, I think the information asymmetry between partners and how that fuels decision making is like the number one internal complexity that it's so hard to challenge because there's really um, you have to really put frameworks around it. You have to put a system in place. You have to think about adding, hey, if I am on, the board call or LPAC call, I have to make sure that that information gets to my partners, but they weren't there in the moment. So how do I make sure that they have that same, not just the data and information from whatever I can type out on a page, but the nuance and all of that, such that, when we or they go to make another decision, everybody feels like they're operating from the same foundation. I think that's what gets really hard when you have, a higher volume of portfolio companies or a higher volume of funds. So that's the number one thing. And then it becomes people start to weigh, again, when it comes to follow-on capital or when it comes maybe for adding new initial investments into a portfolio, you start to weigh your decision making based on the fragments of information you have if you don't have the whole
Mm,
picture, which I think can put the portfolio at a potential disadvantage. I also think related to this is the relationship and the relational work. You guys actually, I know you don't know that I'm about to say this, but you guys had an amazing blog that was you posted on your website. It was about using AI to strengthen relationships and not just cut
mm.
time. So no notes, like it was great. That's better said than I could say myself right now.
I wish I could take credit for that too, but that would be Matt, Angelina, someone on our marketing team put
Yep.
that one together. So that's awesome to hear.
Yep.
This is like a totally biased, self-serving question, but I'm going to ask it anyways. So I think one of the things we hear a lot, especially from like emerging managers throughout the years, is like 3 or 4 years ago, was like I'm going to build this myself. And 3 or 4 years ago, it was by this I mean visible. It was maybe cobbled together. It's like Airtable plus Zapier and something else, and they would kind of build a scrappy version of Visible. And now I think we're hearing more and more. Instead of I'm going to build it myself with those tools, it's like I'm going to use Claude Code or I'm going to use Claude. I'm going to build this myself with OpenAI. Um, and I'm curious. I don't know your answer to this actually, but like, is
Yeah.
that something like how do you advise funds that are like building bespoke technology for themselves versus buying something off the shelf, whether it's Visible, Affinity, some other named vendor that does this. Like, how do you think through that or advise funds you work with?
Yes. So I have been in those shoes multiple times. And I think I kind of have always come to the same conclusion. I think there's a lot of value in buying, then building. And
Mm,
so buying your base solution and building on top of it. I think challenges that people fall into, whether it's GPs, LPs, or founders internally for their own tech stack, is like you're trying to find something that fits like your exact custom solution down to every single specific nuance, and you don't find that in the market. So then you decide to build from scratch. And that path is fine and it can be successful. But what I think that fails to account for is just the opportunity cost of time, because effectively you're either pulling some semblance of resources, whether it's capital or people, to then be focused on that problem and focused on building that. And you may want those, you may be resource constrained, right? Where you can't just kind of throw money at a problem. And so it's a challenge though, because you can't bring in necessarily, someone who has no context for your organization to just build something from scratch. So you inevitably end up, whether you like it or not, bringing somebody that has the context for your organization over to that, which comes at the expense of their time focused on the main thing. I think that can be definitely successful, but today there's so many tools that can make that even more successful. The challenge and the what I think people might overlook around that is the upkeep. So that's all well
hmm
and good when you get it up and running. But then I've seen this come up very frequently recently. It's once you have it up and running, you have to then go in and deal with maintenance and you have to deal with things breaking. And again, that's a distraction from the main thing. So that's kind of one path that I see. Again, it can work, but I think it's really challenging in what I'll say is like an emerging manager space, which is probably big generalization here, but probably quite resource constrained, both in terms of time and capital.
hmm
The build, or excuse me, the buy and then build on top, I think is actually very different and very advantageous today relative to what it was maybe like 5 or 10 years ago. And again, I think there's a little bit of a trap people can fall into. I alluded to this before with all of the different tools these days, where like there's lots of ways that you can surface interesting information, but what's interesting is not always productive. And
mm,
so if you have somebody who gives you this like baseline product that's giving you everything that you absolutely need to build your business, then anything you build on top is because it's adding value. It's not necessarily like you're getting distracted because you're in this big web of building software internally. We have, I guess, just to like kind of pull the curtain back a little bit, we have a
sure.
role of testing something for give or take about 3 months, which I actually have to credit a GP that we work with for this framework. I thought it was really, really savvy. It's long enough that you feel like you can figure out if something's actually useful because it's not just like this 1 week trial and you're like, wow, this is amazing.
Yeah.
I'm over the moon. It's like you're actually working with it in your day to day for long enough. But it's short enough that if you need to pull the plug on it, like, cut it off from being a distraction, it's really not going to be that detrimental to the rest of your business, generally speaking. So that's one framework we have when we think about this like build versus buy mentality. But I am definitely a big, big fan of like the buy and then customize on top of it.
Have you seen on like the customize on top, any examples come to mind? All different parts from sourcing to support to even back office, like anything interesting that you can publicly share that you've seen funds do that like takes a vendor and then put something on top that kind of is their own unique spin, whether that's finding more interesting companies to invest in for sourcing or something else.
I'd say in the space we operate in, it's generally not around sourcing. I think it's more
Mm,
of the speed of transmitting data and speed of
mm.
aggregating data. And so it's cutting down the time that people have to spend aggregating and analyzing and actually just letting them like immediately start, on the 10-yard line as opposed to getting all the way down the field. Um, so in terms of specifics, I'd probably have to file that under
Yeah,
our coffee conversation, but I
sure.
think the number one thing is actually folks that can then surface these data variables and inputs. And what's really, really, really changed in what I've seen in a lot of reporting for folks that don't have a lot of resources is they're able to actually produce things consistently. Because I think it's great if you can go on this like great scavenger hunt and piece together all of your portfolio data and underlying metrics of what's going on. But then the next time you have to do that, that's actually a real test of if your systems are in place and are working. So I think that's where some of the customization on top. I know that that's with some of the groups that we work with or with that our GPs work with. It's always about thinking through like, hey, you can provide me this baseline of information, but I also want, these call it 20 data points every quarter, every month on demand. And I think that's the customization that tends to work.
Yeah, I think like AI has such good tailwinds there. I call it like the last mile of like design, right? Because like everyone kind of has their own flavor of, how they want something to be presented, whether it's in their own branding or whether it's, and a PDF versus PowerPoint. And like
Yeah.
AI has like great superpowers. Like, I mean, that's what it is. Like it's generative. So it's fun to see like now that I've been doing this for over 6 years on the venture side, like how funds have adopted that into like the last mile, where before it was like, hey, I need this thing to look this exact way, which is totally
Yeah.
fair, and now it's like, oh yeah, that actually can happen. We can do that, or we can help you do that, which is exciting.
Yeah.
Uh, kind of switching back to some of the like going more towards platform, a little bit out of the build versus buy, but like at what point does a firm like I'm sure it depends, but like when do you need like an operating backbone, like across your finance, your ops team, your platform team, maybe you have a data team at some point. Like when do you
Yeah.
need like that, or when do you start to suggest like looking into some of those more professionalized processes in within the firm?
Yeah, I think there's a couple key business milestones, and this may not apply to everybody, so I'm not meant to be, again, overly prescriptive, but I actually think when there are multiple products investing at the same time, so whether that be like an opportunity fund or parallel or select or like whatever we're calling them these days, anytime you have two investment products running side by side at the same time, making net new investments. I think that that's like a very clear indication that you need some sort of operational support, whether it be in the finance realm or platform or data, just because you're now introducing the concept of having to juggle conflicts of interest between the two products.
Mm-hmm.
And I think, like, again, having really clean documentation, really clear systems around that is really important. I also would say maybe just more of like a human comment is your ops don't need to mimic every other firm at your stage. And they don't need to mimic like, gosh, I'm a fund too. I just raised, I don't know, 50, 100, whatever it is. Performance is like really revving. I'm gonna now go and set out, and build my like, big name multi-stage firm has this big platform team or something. Like you don't have to necessarily go and follow that just to be able to check the box and um, you know, run your firm the way that you need to. So I think some of it can be like this shiny object distraction of like, gosh, they're so polished over there and they have this all together. And I feel like I need that. And I think that can be a distraction for folks feeling like they need to fit some kind of mold. But I think, again, the ops, anytime there's like an opportunity fund or kind of different strategies, even if it's not an opportunity fund, whether it's like, hey, this is a more sector specialized sub fund that I'm going to end up doing. I think that that's a really important place. The other piece would be anytime you're adding kind of additional layers, I think, of investment talent. I think sometimes that can also be really helpful because it can help manage and give the apprenticeship experience to more junior folks where they can also then be understanding the operations. I think that learning and building operations is like one of the number one ways that you can be such a really well-rounded investor as you kind of go and scale through this venture world. Like I know that we're in a world where like generations want to be like, an investment partner in like a year. It doesn't work that way, but I think that learning and understanding the internal ins and outs of, how a deal comes together, how a deal gets reported on, how it gets all the way through to stakeholders and whether it's a board of trustees or whatever it may be. I think that that's an area where having kind of like whether it's a finance person or someone that's managing your operations can also be helpful because those two folks can work in tandem. And that's kind of solves that problem before of like you have someone coming in who doesn't have your business context, you have someone who does have your business context, and it can marry the two together.
Yeah. Amazing. I love it. All right, great. We'll move on. A few slides left. So if anyone saw a few questions come to me personally, so if anyone has any others, feel free to send them. But getting down to like the LP communication, which we touched on a little bit already. Um, how I guess maybe a question is like, do you see um, like is LP reporting, good LP reporting, a competitive advantage and not just compliance? I guess is maybe my question. But what we have here on the slide too is like what differentiates firms that report just because they have to versus maybe like a long-term competitive advantage or building loyalty.
I think it can be a competitive advantage. Again, it can't be your only advantage, and it can't be everything that you offer, but I certainly do. And I am a big believer that there is a lot of value in pausing and writing a quarterly letter to your LPs, or whatever your time cadence may be. Again, might make sense to do semi-annual depending on where you are in your investment period, but I think that there's so much value in doing that and not using AI, by the way, to like produce the whole thing and then just ship it out. Like I think that there's a lot of value in sitting down both in what you send out to LPs, but for the GP or whoever is kind of coming together to produce that, to sit and just like pause because it both is a reflection, but it's also kind of a positioning for going forward. I think that that is where a lot of LP loyalty can come into play because I think the loyalty comes out of sharing the bad news. And when you're forced to
Mm.
report on a consistent cadence like that, not just the financial statement requirements, which are all extremely important, but when you're forced to kind of process and synthesize a lot of the challenges and be transparent around different learnings and things that are going on in the business, I think that that's where you build rapport and you build relationships with your LP in a maybe it doesn't feel like you're building a relationship because you're not like sitting on the other side of the table having lunch with them. But I think that that motion shows like, hey, I have consistency and I'm dependable. And here's, I'm not just sharing with you that it's all like rainbows and puppy dogs because most of the time it's actually not. And I think I personally, as an LP, really value when folks are upfront that there's challenges in a business because there's like two red flags for me. Anytime someone's like, I have no loss ratio, and I'm like, you're lying, it's there. Like, which companies are you concerned about? And that's okay, because by the way, that's venture. Like, hello to the power law. That's one thing. And then also when they're like, look, Fund One did great. Like, haven't learned anything. I think everything's working as expected. No changes for Fund Two. Let's just run it back. And I'm like, that's insane because the markets are fundamentally different between, 2, 3.5 year periods or whatever it may be. So
Yeah.
I think that the LP reporting is really critical. And then, of course, this is where kind of back to the conversation around, adding custom things. When you know what your LPs need to do their job, you have an opportunity then in your reporting to showcase and give them proactively the information that they need, or to come up with a forum where maybe it can't be spelled out in your quarterly letter, but to come up with a way that you can keep them informed proactively. Because again, that's what partnership is. Like it is, limited partnership, right? Like strip away limited. That's really what it is at the end of the day.
It's really no different than, I mean, we do a lot of work on the founder side. It's like the best founders that send investor updates, like always include challenges in what's going on, right? They don't kind of hide the bad news. And then the second they stop sharing, um, is like the second, kind of something's wrong too, right? Or like, the format changes a little bit because they're trying to swap one thing out for another. It sounds like the same principles apply from GP to LP.
Yeah, and actually, it's such a like it feels trivial, but it's actually really important. And I'm ultra type A, so of course I would say this, but like the formatting actually does matter. If you get like a different formatted quarterly letter every quarter, it like sends your brain, at least for me, I'm like, what's going on here? Like, why is this changing? What's like, I'm not getting the same information quarter over quarter. So something, even if it's just totally, totally harmless, right? Like that's where an LP's mind goes is like they want to see that things are working, that they are moving forward, that you're being intellectually honest about what's going on. Not that there's no challenges, although maybe there's a class of LPs that, might not be as long-term oriented in that view. But I think that that's actually really important is like having a
Yeah.
consistent outline for people.
Yeah, great. All right, we got just a few slides left. Getting into like fund two and beyond. And outside of returns, which sounds like again number one, but like you manage, you evaluate managers very early. Like, what signals can you tell from a firm that they can scale beyond, fund one and become, a true platform and have, a multi-vintage firm?
Yep. So I think one is actually that LP communication quality. And I think it's really important to arm LPs with the narrative. Like you can give them all the data and all the numbers, but like they need to have and understand the narrative. But aside from that, I think there's two things I think about is, operationally how they handle their first loss or a struggling company. I think that's always going to come up, especially where we focus in pre-seed and seed. I think that can be the most informative data point. It doesn't feel like data because it's not a number, but it's the human and the people side. And again, I think a lot of like the operations and, workflows and communications feed into that. So that's kind of one area that we spend time on is just understanding that and understanding kind of like the mental processing of that. And then the other element I would say that we think about too from an operational standpoint is just self-awareness around some of like the gaps in infrastructure and where that time is. So we have a lot of conversations, I'd say, at the inflection point between like a call it a fund two and a fund three around that operations hire. So whether it's kind of going with a solution of someone who's based outside of the US, whether it's going with kind of a part-time or fractional CFO and getting additional support there, whether it's, I'm a big fan of like a chief of staff type role where you have someone who can be a little bit dynamic across and understand, again, have the business context, but not be focused on investing and think, long and hard about what some of the, I like to call it like making sure there's like batteries in the keyboards, like thinking of like that level of detail so everybody else can be focused on other things. I think that there's GPs can gain a lot of credibility with LPs when they say like, we know we need to find, X solution because this is where we feel like we are stretched on bandwidth.
Hmm, great. Kind of related to that, like what tends to break between funds one and three that maybe I am not anticipating? Like, is there like a common theme you see that jumps out on the page to you? It's like, yeah, we see that all of the time.
Yeah. I mean, there's a lot of things. But I think one thing that comes to mind, it's less like a specific topic. I think usually by fund two or fund three, like you have a fund admin in place, your financial reporting is going well, you figured out your motion with your LP reporting, or you're starting that because you've kind of introduced some institutional LPs into your LP base. I don't know, I think about something that's like a little bit more intangible where when you go from call it fund one to fund two or fund two to fund three, you have more data and you have more operational or investment experience working under your firm name. And so what that means is that you have obviously you're managing a portfolio and you have these companies that are hopefully starting to break out, and then you have those that are not necessarily going to be in that category now or ever. And so you end up feeling like whether subconsciously or emotionally or behaviorally, that there's like you've made a mistake, right? And so you've made a mistake by that investment. And so you're like going through and you're trying to look at like, why did I invest in that when I did? Like, what was I thinking? What was my frame of mind? Like, how do I start to pattern match that to what I'm seeing now? And there's a difference between trying to correct for a blind spot or correct for a mistake versus overcompensating and just saying like this is part of taking in new information. And so we see that play out whether it's there's things that are as like binary as like sector bets of like, oh, I invested, there, so I'm never going to invest there ever again. And there's like absolutisms. But there's other things like, gosh, I invested, with somebody who, what's a good example? Like came from that school or something. And like, I probably need to like stop sourcing deals from that school. And then they like look at everything like very coded to that mistake. And so we see that sometimes where it's like, well, I can't ever do a deal if I'm not going to get X ownership anymore because I did it in that and it didn't work out. And there's this like weird pattern matching that people try to do versus just saying like, you know what, that was like a series of, things that didn't work out. There's reasons for that. I've changed whether it's my diligence workflow or I didn't see this with the founder before. So now I need to adjust my process a little, and then go from there. So again, it's like this difference between like, just making little tweaks because you're evolving versus like completely overcompensating and changing your model.
I think that exists in all business. I do that myself. Sometimes you're
Yeah, it's
like,
so hard. It's so
so
hard.
something's gone wrong. You're like, you look at it, you're like, oh yeah, that deal had this, and this is, so it's like, I think, yeah, that's super interesting.
Yeah.
Well, awesome. All right. Oh, go ahead. Sorry.
I was just gonna say it happens in fundraising too. Like that's probably the place where like we also see it shine through and it can like really hit a GP's confidence where it's like you have one LP, you're like, gosh, I got them through the whole process and then they passed at the end. Like, what's going on here? And then you're like, oh, well, they gave me this feedback, so now I need to go and change all of my materials and all of my portfolio model because, they told me that I didn't have enough companies in the portfolio or they, didn't like this slide, so I need to change this slide. And it's like, no, like it's not going to be for everybody, and that's okay. So
Yeah.
that's like another way that we kind of see that start to come through.
Yeah. We were literally talking about that today internally. We were like talking about being quick and nimble, but not like reactionary, which I think are
Yes.
two different things.
Yep.
And important to call out. Great. If anyone has any final questions, please write them in. I got one here before we wrap up, which is like, so it sounds like a lot of the things from like bias and some of your mental models, Lisa, have been really interesting. Like, are there any like blogs, books, podcasts, like anything that you like to listen to or suggest people listen to like tap into some of these things?
Ooh, that's a good question. I'm like staring actually at a bookshelf right now. I should pick out some names from there. I think the Annie Duke books are great.
Okay.
I also think for what it's worth, bias shout out here, but Hunter Walk produces a lot of really thoughtful content around just like I'd say a lot of the things that our GP advisors are working with our portfolio on. And that's like some of the nuances. Like Hunter obviously has been, however many funds and has the experience going through. So when helping, an emerging GP go through something that he's seen before, it kind of feels like you can help them see around corners. And so he brings a lot of that to his blog, whether it's around like the secondaries podcast you did around
Yeah.
safe adjusted
Yeah, I
portfolio
just saw that
metrics.
one.
Like that
Yeah.
was the latest. He actually had a really great, this is maybe for folks that are earlier in their careers, but he had a really great link blog over the weekend that had a link to somebody, and I don't know who it was to give them proper credit. It's escaping me right now, but it was around like how to actually utilize and ask people for help and like not just like
Mm.
ask them to hop on, a quick 30-minute call with zero context. Like some things can be handled over email, like how to stage the ask, how to navigate, like, and do a follow-up and close the loop, which like no one I don't think is perfect at. But I think that for what it's worth, like that type of content I think is really helpful just because it's informed by real world experience that's like happening now in the market.
Yeah, well, awesome. Lisa, thank you so much. I promised 45 minutes. We're a little over, so thank you so much for joining us today and sharing all of your expertise and wisdom with us. I'm glad our paths crossed. Like we started the season one of our podcast all about like AI is here, but relationships matter. And so I'm glad our relationship with Hunter got us to you in Screen Door. And just can't thank you enough for spending 45 minutes with the visible community here today.
Yeah, thank you guys for having me. Good to see so many familiar names here, and look forward to seeing everybody
Yeah,
in real life.
awesome. All right, see you everybody. Take care.
Bye.